Okay, I'm going to show you guys how to recoup your losses on a stock that you've been holding on to that has just simply kept falling. And the idea here is you're looking for a stock that's going to go back up. And that in itself is already hard to predict. But let's say you don't want to take on any more risk, you don't want to double down on the stock, and you're not sure if it's going to go up, but if it does go up, you want to recoup those losses very quickly. And if you're just holding the stock, you're not going to recoup those losses quickly because let's say the stock falls 20%. Well, you have to see the stock rise 25% just to break even. But what I'm going to show you today is how you can actually double or more than double the speed at which you recoup your losses. And the way we do that is with a certain option strategy. So the stock we're looking at, for example, is this Aurora cannabis stock, and it has fallen a lot. At its peak 2 years ago, it was about $100 per share. Now it's trading at about 8.9. Now let's say you believe that it's going to go back up. That's why you're still holding onto the stock, of course, and you want to recoup that more quickly. The best way to do it is through not selling your stock and restructuring via options, but simply adding an option strategy to whatever you're still holding. So let's say for every 100 shares, let's say you're holding 100 shares of ACB. What are you going to do to recoup your losses more quickly? Well, you're going to go look at options for any month. Whatever your time horizon is going to be your best expiration date. So I'm just going to choose January 21st, 2022. They're very liquid, you can see. We got decent volume, high open interest. What you're going to do is you're going to look for the strike price that is closest to the actual price of the stock. And for us, that's about $10. Now, go and look at the call options on the left side. You can just look at calls if you want. That'll make it easier. So we're looking at this $10 call option, and you can see that the bid and the ask are very tight. So you're going to be getting that for about $3.45. Of course, because it's an option, you'll be paying 100 times that price, so $345. And what you want to do next is you want to go up through the strikes until you find the option that is half the price of this at the money option that you're going to buy. So we're looking for about 170, and this one looks pretty close, the 22. Now here's how you do it. You buy one of these 10s, and you sell two of the 22s. Now what that does is it gives you a risk-free option strategy. Why is it risk-free? Well, first of all, it's free because you paid $345 for this one, but you sold two of these. So you're basically even on this strategy. Now the thing is, this strategy is going to help you recoup your losses quickly, more quickly, double the time basically, as if compared to just holding the stock. And the reason that works is if the stock goes up, your stock value obviously goes up, but it goes up 2 times because you're simulating holding 100 extra shares because you're at the money. Now it's going to go up about half the speed of the stock at first until it gets high enough up there to where the delta right here is near 1. But in general, you can just think of it like this. You've doubled the amount of stock you're holding, essentially, but without the risk of buying more stock. Why is that? Well, if the stock continues to fall, you have no risk. The reason is you paid nothing for this. So if you lose, if the stock falls down to $5, for example, this expires out of the money. Well, so do these two that you sold. They expire out of the money as well. So you've lost nothing because you paid nothing for it. Now, if the stock moves up, you're going to recoup whatever you got in the stock. Plus, this at the money option is going to become in the money. And your call options could be worth a lot more, essentially double if it goes up high enough. These are also going to increase in price, but if you chose your expiration date correctly, what's going to happen is they're going to expire out of the money. So you're going to put this around your price target. If you think that ACB is going to go up to 22, but not surpass 22 by this date, then this strategy is perfect for you because these will expire out of the money. You'll recoup whatever you had in the stock, plus you'll get extra profit from this one. Now, if the stock goes up and it looks like it's going to go past 22, what you can do is you can just buy them back. and you can still hold on to this one if you think it's going up. And technically you lost money here, but you made money here, and you're already holding double the amount of shares to that than when at the beginning when you're just holding stock. So you've recouped everything. You've essentially doubled your gains, and this doesn't really matter because it's out of the money in the first place, and you paid nothing for it. As long as the stock doesn't go past 22, you're making extra money. If it does go past 22, you've basically capped your profits, but you haven't lost anything. So if the stock really goes, if it like gaps up, which is rare, but it can happen sometimes, usually if it's going up, like right here, you have time to buy back those calls. But even if you don't buy back those calls, you don't have any extra risk on the upside. You're just going to cap your profits. That's it. So this strategy is pretty useful. It doesn't require any margin. It essentially just lets you recoup losses when you're holding on to shares of a company that's been falling. This is called the stock repair strategy. If this has been helpful, let me know in the comments section below. Don't forget to like and subscribe. Thank you.